Let's start with the sixth session of module 1 of the course, and this particular session is going to talk about the most mysterious of all asset classes. The asset class which has garnered the maximum news till date and continues to garner the maximum of real estate space in a newspaper even today. The asset class which has maximum number of people sitting and trying to analyze the various factors that affect it and trying to come out with formulas, trying to come out with ways in which they can make money in this particular asset class, analyzing the various factors that affect this asset class, analyzing how this asset class responds to various external changes. There are thousands and thousands of managers sitting all across the world trying to figure out that secret sauce that can make money for them in this particular asset class. By now, you must have guessed what we are going to talk about. Yes, we are going to be talking about equities as an asset class. In this session, we will give you an introduction into equities as an asset class and help you get started with your investment in equities. Whenever we talk about equities, it tends to have very divergent views. You have one set of people who think that investing in equities is gambling, whereas a second set of people who think that equities is the place where you make money. Irrespective of which side of the fence you belong to, if you were to think about equities, there is a kind of mysteriousness around it. Why? Because it is one of the most complex of the asset classes because of the numerous number of factors that affect it, both external to the company as well as internal to the company, and how the market reacts to various factors affecting it. It's not easy to decipher, and we will try and simplify this for you today so that at least you get a hang of what this asset class is all about. If I were to attach a Hindi film dialogue to equities as an asset class, I think it would be equities se bachna mushkil hi nahi, namumkin hai. Because this is one asset class you cannot run away from. This is the asset class which will constantly gather or ask for your attention based on the movements you see in this particular asset class, the kind of returns you see in this asset class, the kind of wealth creation this asset class has done for decades together. Let's start with the all familiar risk pyramid that you've been seeing with us in every session. If you look at the risk pyramid, equities lie right on top of the risk pyramid. The reason being, this is one asset class which attracts the maximum amount of risk, but also with expectations of commensurate higher returns compared to any of the other asset classes that we have discussed till now. Over a period of time, equities as an asset class have been the biggest source of wealth creation among all asset classes. Why and how is what we will talk about in today's session. What exactly is an equity share? An equity share is basically your piece of ownership of a company. What do I mean by that? When you own a particular share of a company, you are entitled to that much fraction of the future earnings of that company. Let me put things in perspective for you. In the good olden days, the source of wealth which a person would have was measured in terms of the amount of land he had. So the more land a person had, he was considered more wealthy based on his land holdings. As time passed, the measure of wealth moved from the amount of land a person had to the amount of cattle he had. Cattle could be in the form of cows and buffaloes, or horses and goats, or sheep. Basically, the more cattle one had, that was a measure of one's wealth. In the early 1900s, with the dawn of the Industrial Revolution, the source of wealth creation changed dramatically. From land and cattle, it moved on to industries. So if you wanted to be wealthy, if you wanted to create a lot of wealth, you needed to own those industries which were manufacturing products which were being sold on a daily basis to the common people. It is not possible for everyone to set up an industry, and that is where the ownership of these industries in the form of equity shares came into being. So if you wanted to participate in this industrial revolution, you wanted to be a part of this equity ownership, then the way you could do that is by owning a part of the company which run these industries. And how do you own a part of this company? By owning an equity share of the company. In the past few decades, no asset class has created wealth for investors or entrepreneurs as much as equities. To give you an example, if you were to look at some of the most commonly sold products around you, Nestle India, the company that owns the brand Maggi, sold close to 2,64,000 metric tons of Maggi in India in the year 2019. If you look at the all popular Bata company, they sold close to 47.25 million shoes in India in the year 2019. And it's not just about brands which are available in India. If you talk about global brands, look at a company like Coke. It is estimated that 10,000 soft drinks of Coke alone are consumed globally every second. So you can imagine that if this particular company is earning an X amount per bottle being sold, how much wealth are they creating on a second by second basis? And how by you owning an equity share of this company, you can participate in this wealth creation that is happening every second of the minute, of the hour, of the day. So when Nestle India sells crores of Maggi packets in India, they are creating a lot of wealth as a company. And how you as an investor can participate in this wealth creation is by owning a part of this company. While we will look at the various factors which affect equities as an asset class, let me show you the equity risk meter, which you are all familiar with by now. If you look at the risk meter here, you will see that equity as an asset class belongs to the highest risk compared to all the other asset classes. The average returns Indian equities as an asset class, which is measured in terms of the returns which BSE Sensex has given, is 16.1% since 1978. What exactly is BSE? We will look at it in the subsequent part of the session. While the average return has been 16%, if you look at the actual returns which an investor would have earned, it varies from minus 47% all the way to plus 267%. So you can see that the kind of varied return you experience as an investor in equities is something which is not meant for the faint-hearted. Again, going back to what exactly is risk. Risk is nothing but variability in return. The more variable the return, the more risky that particular asset class is considered to be. If an asset class is giving you a return with such a range from minus 47% to plus 267% in any 1 year, so you can gauge the kind of risk associated with such an asset class. If you look at the historic returns of equity as an asset class in India for the last 10 to 12 years, if I put it in the form of a chart, you can see that markets would have fallen by 30% in a year, or would have even doubled in a particular year. It is not uncommon to see that in such a short history. And that is why it is said that equity is the most riskiest of all the asset classes. Now, does that mean that you do not invest in equities or you run away from equities? No, since equities as an asset class are the ones that create the maximum wealth, what you should be doing as an investor is learning how you can manage this risk. Because when you're able to manage this risk well, that is when you will be able to get maximum out of this asset class. It's very similar to if a lot of accidents happen on the road, does that mean you don't take your car out? You will definitely take your car out, right? Because you want to reach from X place to Y place. Similarly, you want wealth creation to happen, you would definitely want to invest in the asset class like equity. There would be ups and downs in the ride, in the journey, there would be bumps ahead. But if you have the expertise to manage this, if you know how to manage the risk associated with this asset class, you will be well set on your journey to wealth creation. While we will talk about the various risks associated with equity shares as an asset class, let's first look at how do you earn returns by investing in equity shares. When you invest in an equity share of a company, you expect to earn returns in two forms. One in the form of share price appreciation and second in the form of dividend returns. What do you mean by share price appreciation? Is you buy the equity share for a certain price and you expect the price of the share to go up over a period of time, and when you sell it at a higher price, you realize a gain from selling that share which you bought at a lower price. The second way how you earn returns in equity is in the form of dividends. Dividend is nothing but the way in which the companies distribute their profits among its shareholders. Companies, as they run their operations, they earn profits every year. They decide what they want to do with these profits. If there is a requirement for the company to put the money towards expansion of the facilities of the company or increasing its capacities, it will use those profits for that. If it thinks that it does not need all the money, then part of it can go towards paying out to shareholders as dividends. So dividend is nothing but the part of the profits the company has earned which is given back to you as an investor, and that part of the profits which is not given back to you is reinvested back for the expanding the operations of the company, which should eventually result in higher profits tomorrow and which will have a direct impact on the share price of the company. So the profits which the company earns can either be paid out to you immediately or they can be invested for future growth of the company. If they are paid out to you, you receive cash in your hand. If they're invested for future growth of the company, you expect that to reflect in a higher share price tomorrow when the company realizes that future growth. Let me run an example with you so that you understand how you make returns by investing in an equity share of a company. Here we've taken the example of HDFC Bank. If you were to buy 100 shares of HDFC Bank on 5th of January 2018, the prevailing price was INR 931 rupees. After you purchase a share, this chart shows you how the price of the shares moved till September 2020. So you can see that the price of the share went up to 1055 and all the way up to 1268 before it crashed in March 2000 because of the COVID pandemic to a low of 761, and it recovered most of the losses and was back at 1049 in September 2020. So if you bought the shares at 931 and today the price was 1049, the differential between these two is the profits that you make as a result of appreciation in the value of shares of HDFC Bank. In addition to the appreciation in the value of shares, the company also declared dividends 3 times in this period from January 2018 till September 2020. The first dividend was declared in April 2018, then in April 2019, and finally in July 2019. The amount of dividend declared was INR 13 per share, INR 15 per share, and INR 5 per share respectively. So that is the amount of money that was given back to you from the profit share of the company. To the extent of dividend given by the company back to you, the share price of the company would have reduced. Why? Because it was money which belonged to the company which was given back to you as a shareholder. So to that extent, the value of your share would reduce, and that is why when we look at the total return you earn from investing in equities, we add the share appreciation plus the dividend amount that is paid out to you, because once the dividend is paid to you as an investor, the company does not have any control over what you do with the money. When talking about dividends, let me introduce another term which you should be familiar with, which is known as the dividend yield. What do I mean by dividend yield? It is nothing but the portion of the earnings that you get back in the form of dividends when you make an investment in a stock. So if I bought the stock for 931 rupees and I earned a dividend of 13 rupees from that particular stock, the dividend yield for me as an investor is 13 by 931, which is 1.40%. So basically that much percentage of my investment I get in the form of dividend yield or in the form of returns on a year-to-year basis as and when the company decides to declare a dividend. One thing you should understand is statutorily the company is not obliged to declare a dividend. Whenever they earn the profits, they may decide whether they want to declare a dividend or not, and how much of this profit they want to give out as dividend to the shareholders and how much they would like to retain for the future growth of the company. If you were to look at the total returns you made by investing in equity shares of HDFC Bank over a period of 1 year, that is 2019, on 1st Jan 2019, the price of the stock was 1074, and on 1st Jan 2020, exactly 1 year later, the price of the stock was 1278. The stock had appreciated by an amount of 19%. Similarly, during this period, the company had a dividend yield of 1.21%, which was arrived at when you divide 13 by 1074, that is the purchase price for you as an investor. This gives you a total gain made on an equity share of HDFC Bank in 2019, which is equivalent to 20.21%. When you invest in equities, it is not uncommon that a very small portion of your return comes in the form of dividends and a much larger portion comes in the form of stock appreciation. Since we are on the subject of returns from equity shares, let's also talk about the taxation that is applicable when you invest in equity shares as an asset class. When you invest in equity shares, you earn returns in two forms. One is in the form of stock appreciation, which is also known as capital gains in tax parlance, and second way you earn money is in the form of dividends. The government taxes the capital gains differently from the dividend income. First, you need to determine whether the capital gains that you've made are long-term capital gains or short-term capital gains. If you've held the stock for less than 12 months, it is considered as short-term capital gains, and if you've held the stock for more than 12 months, it is considered as long-term capital gains. Once you are able to determine if you held the stock for less than 12 or more than 12 months, the next question is, how much will I get taxed? If you've held the stock for less than 12 months, you will be taxed at a capital gain rate of 15%, 15. So short-term capital gains for holding a stock for less than 12 months is taxed at 15%. Long-term capital gains, that is for holding a stock for more than 12 months, are taxed at a concessional rate of 10%. The government wants to encourage you to hold equities for a longer period of time, for which they give you a concessional tax rate if you sell the stocks after 12 months. When these stocks are sold after a holding period of 12 months, it is called as long-term capital gains, and not only are they taxed at a concessional rate of 10%, but every year capital gains of up to INR 1 lakh are tax-free in your hand. So as an investor, the first 1 lakh of long-term capital gains that I make in equity shares, they are completely exempt from any kind of tax, and all the gains beyond 1 lakh are taxed at the concessional rate of 10%. This is how the appreciation in the value of the stock is taxed by the government. Now what you should understand here is that you pay taxes only in that particular year when you sell these stocks. So if you're holding a stock, like we had seen the example of HDFC, if I bought a stock on 1st January 2018, on 1st January 2019 I have not sold the stock, although I have made a profit, that is called as a unrealized gain. I do not pay any taxes on it. I will pay taxes only the day I sell the stock and I realize gains which come to my bank account. That is when I pay taxes. I do not pay any taxes on unrealized gains. The second way you earn returns when investing equity is in the form of dividends, and dividend income is straight added to your income. So whatever dividend that you earn in a particular year, it is added to your income and it is taxed as per your slab rate. So if you fall in the 20% tax slab, you pay a 20% tax rate. If you fall in the 30% tax slab, you will pay a higher tax rate. So just like an interest income that you earn by investing in any debt product, that is added to your income and taxed as per your slab rate. In the same way, dividend income, that is the regular income that you earn by investing in an equity share, is again added to your income and taxed as per your slab rate. Now that you understand how you can make returns by investing in an equity share and how they are taxed, before I get into details of how does the stock market exactly work, let me quickly show you a video which will give you a glimpse of how the markets worked in the 1990s, which is not very far, it's about 25-28 years back, but it will give you a glimpse of how the markets were and today how the markets are and how much they have evolved over a period of time. Let's understand the process that goes into buying an equity share. You as a buyer, when you want to buy a certain number of shares, first you allocate funds from your bank account towards your trading account. Once the funds are allocated, after that you are ready to place an order with the stock exchange for buying the share. When you place an order and the order is executed by a stock exchange, the money is transferred to the exchange, and in turn what you receive is the equity shares of the company for whom you had placed an order. These shares go and lie in your Demat account, which is nothing but a dematerialized account where you can hold all the equity shares that you have purchased. Now, what you saw in the video was the way trading used to happen in the past, where the buyers and sellers used to stand across each other and yell at each other saying that I want to buy a certain share for so much price, and try to figure out if there was a seller for these shares at the price they wanted to buy at. And that was the result of all the buyers and sellers coming together on a particular common platform. And this platform, I mean, is a physical real estate space where all of them are standing next to each other and literally shouting orders at each other with respect to what share they want to buy or sell. Now, at that point of time, the volumes of trades were much smaller and maybe they were manageable, although in a very messy and chaotic way, as we saw. But if you look at the number of trades that happen in the market today, it is next to impossible to have a similar way of buying and selling shares. Just imagine all of us getting together in a single place and standing and yelling for how many shares you want to buy of a Nestle India or of a SDFC Bank. The entire process has been streamlined thanks to technology, and today the complete trade cycle is much more sorted for you as an investor. With the technological changes that have happened along with the regulatory framework, the entire process of buying and selling a stock has got streamlined, which is a complete different flow compared to the mess that you see in the video that we just saw when people used to buy and sell shares in the 1990s. The stock exchanges today have appointed brokers who act as intermediaries to take orders from the various buyers and sellers and in turn place them on the stock exchange, which is the centralized place where the exchange of shares and exchange of money happens. So when you as a buyer want to buy a particular share, you would open an account with a broker, which is a trading account, and the trading account basically gives you access to the terminal on which you can go and place an order for these shares. So you transfer money from your bank account to your trading account, and from your trading account you place an order for certain number of shares. Once the order is confirmed by the stock exchange, then the money flows from your trading account to the stock exchange. From the stock exchange, it flows to the seller's broker, and from the seller's broker to the seller's bank account. The seller in turn transfers the shares which he has sold to you as a buyer, and those shares move from his Demat account to the broker's Demat account, and from there to the stock exchange, who in turn passes on those shares to the buyer's broker's Demat account, and who finally gives the shares in your individual Demat account. So you can see, just like what we are very familiar with, wherein the banks play a very important role in movement of money from one person to another, in the same way there is a very important role played by the depository participant to ensure movement of shares in the way money moves. We will look at this in a couple of minutes. By now I'm sure you are familiar with the stock exchanges that we deal with on a day-to-day basis, that is the BSE, that is the Bombay Stock Exchange, and the NSE, that is the National Stock Exchange. Bombay Stock Exchange is the oldest stock exchange in Asia, and it was established way back in 1875, whereas NSE came into existence in the 1990s and is currently the world's third largest stock exchange in terms of transaction volume. Whenever you decide to buy an equity share, you would be buying these shares across any one of these two stock exchanges, either the BSE or the NSE. Now, a second very important role which is played is by the depository. Just like when you have cash in hand and you go and deposit the cash in the bank account, it does not matter what particular currency notes you deposited, and tomorrow when you withdraw it from an ATM of the bank, what currency notes are given to you, right? Money is said as fungible, right? It does not matter that you get back the same particular note that you deposited. You can get back a different note, but the value of it is still the same. That was one of the biggest changes which happened when we moved from the era of physical share certificates to the current dematerialized form of share certificates. The video again in the 1990s, where people were yelling and taking orders, shares used to be exchanged between the buyer and seller in the form of physical share certificates. You can imagine the amount of paperwork that used to go into with the buyers and sellers signing off the fact that they have bought or sold a share, and with that particular form attaching the share certificate so that they could be exchanged between the buyers and the sellers on the floor of the stock exchange. Now, as the volumes grew, it was just not possible to manage such a method of doing the transactions, and that is when depositories were introduced. And just like you have two stock exchanges which are the most prominent ones in India, that is BSE and NSE, the two depositories which hold all the Demat accounts in the country are CDSL and NSDL. These depositories basically play the role of dematerializing your equity shares so that you no more have to physically deliver share certificates each time you buy or sell a share. Share certificates have been dematerialized and they are transferred in electronic form, just like money is transferred. So I log into my bank account, I say that I want to transfer 10,000 rupees to an X person. I execute the transfer, give my confirmation, and the money goes from my bank account to the other bank account. Exactly the same way, just like you hold money in your bank account, you hold all your securities in your Demat account. What do I mean by securities? Securities include not just equity shares, they also include a lot of your debt securities. So if you go back to the session we had on debt, wherein we talked about bonds, we talked about debentures, we talked about NCDs. These are all again called securities and they don't have to be held by you in a physical form. Today, some banks make it mandatory for you to hold fixed deposits in a physical form. Fixed deposit receipt is issued to you. But most of the banks have moved on to online banking, and a e-receipt is as good as a physical receipt. In the same way, all your equity shares, all your securities can be held by you in your Demat account with either CDSL and NSDL. And if you need to sell these shares, you execute an online transaction, which is a part of the trade cycle we just saw, that when money moves out of your bank account, when you want to buy a share, and shares come into your Demat account. When shares move into your Demat account, after the purchase is executed, that is the ultimate proof of you owning those equity shares. You don't have to actually deal with any paperwork today because the entire process is online and it is completely dematerialized thanks to CDSL and NSDL. To put things in perspective, there are close to 4 crore Demat accounts in India today. So there are 4 crore participants in the market, and since CDSL and NSDL cannot deal with all of them directly, they appoint what are known as depository participants whom you have to approach and open a Demat account with. Just like I don't have my bank account with RBI, I have my bank account with any of the banks which RBI regulates. I don't have my trading account with BSE or NSE. I have my trading account with the brokers who've been appointed by BSE and NSE. Similarly, I do not have my Demat account directly with CDSL or NSDL. I open it up with a depository participant, an intermediary appointed by CDSL or NSDL, who in turn will open up the Demat account for me. So all end investors deal with the depository participant, who in turn is regulated by a CDSL or NSDL. And typically, if you look at your Demat account, it is a 16-digit number, and whether your account is with CDSL or NSDL, it denotes which participant that particular account is with, and finally whether it's with CDSL or your NSDL. So if we revisit our trade cycle, you can see that there are millions of buyers and sellers who are placing their trades through the brokers, who in turn are communicating those trades to the stock exchange, and post the trades are confirmed, money flows from the bank accounts via the stock exchange from the buyer to the seller, and similarly the dematerialized shares which are held in the Demat account move from the account of the seller to the buyer via the depository participants. And in this entire cycle, the stock exchange plays a very prominent role in guaranteeing that if a particular trade has been executed on the stock exchange, it will be settled. Meaning, if I placed an order for a particular number of shares and that order was executed on the stock exchange, I will get those shares in my Demat account. By this, the stock exchange kind of guarantees in the center that since I do not know the seller of the shares, I may not be sure that when I give the money, will I get my shares or no. And that acts as a big deterrent in placing an order for the shares. So the stock exchange comes into the picture here. Since it regulates all the brokers, it is able to guarantee that every order that is executed will get completed and you will receive the equity shares for the money that you paid when you confirmed a particular order. So now that you understood the various participants in a particular trade cycle, that is a stock exchange, the brokers, the depositories, that is CDSL and SDL, the depository participants, and finally the buyers and sellers, in ensuring that this trade cycle functions smoothly and functions as anticipated, is played by the regulator, which in India is SEBI. The full form of SEBI is Securities and Exchange Board of India. Just like RBI monitors all the banks, SEBI as a regulator monitors all these bodies which facilitate a trade for you as an investor. SEBI was set up with three main objectives, of which the most important is to protect the interest of the investors. SEBI also monitors all these financial bodies which we talked about, whether it was the stock exchange, whether it was the stock brokers, whether it is CDSL and SDL, or the depository participants appointed by them. They all come under the purview of SEBI, and SEBI ensures that they continue to function smoothly and function in a manner that it is beneficial for the interest of the investor. Additionally, SEBI also sets the rules and regulations to ensure that there is no rigging of share prices, there is no insider trading, and all the participants are given a fair deal in this entire process. Now that you understand the entire trade cycle in terms of how money flows from the buyer's account to the seller's account, and the equity shares move from the seller's account to the buyer's account, a common question that gets asked is, why do companies need to come and raise money from investors? Why can't they just go and raise the money from banks in the form of loans? To understand this, you must go back and revisit the debt session. A bank cannot be investing its money endlessly into equities because the bank needs to manage the asset side and the liability side of its balance sheet. When a bank borrows money from a depositor, they have to give this money back to the depositor along with the assured return of 7 or 8%. That is the return they promised on the deposit. The bank in turn tries to invest the money in those avenues which will give the bank a steady return. So it will try to put its money in a particular avenue where it can lend the money at, say, a 10% return, so that it is a steady stream of income wherein 10% is what the bank earns, it pays the depositor 7% and 3% is its profit. If the bank were to go and invest all the money in an equity share, and we've seen the variability of returns for investing in equity shares, which ranges from minus 47% to doubling your money, there is a huge mismatch between the liabilities and the assets for a bank. A bank can never function that way. They will have to ensure that they are able to match their assets and liabilities so that they have a steady flow of income which they can use to pay off towards the steady flow of expenses they need to pay in the form of interest to their depositors. Because of which, when a company is looking for capital for expansion, it cannot be only the bank which is its last resort. If it is an established company with a good track record, they will be able to raise some amount of funding from the banks in the form of loan, which the company has to repay. But if the company is a slightly risky business, and that is where they have to go and approach a external investor to invest money in the form of equity. What you need to understand here is, when I as a company borrow money in the form of a loan, I have to repay the loan and I have to service the loan till the date I repay it, irrespective of whether I make profits or not. So if I have a good year, I will be able to service the interest on the loan. But if I have a bad year, I cannot say the person from whom I borrowed money that I will not service your loan today. I will have to service the loan as a company whether or not I make profits. Whereas with equity investing, so if I have an equity shareholder who's given me money, so here I have not borrowed the money like I borrow from a bank, I've taken money from an equity shareholder. The year I make good profits, I can decide to give back part of it in the form of returns, which we discussed were dividend returns. I can also decide that, okay, this year I made good profits, I will not give you any money because I'm going to use the money to reinvest it for future growth. Or if in a particular year I do not make money, I make losses, if something like a COVID happens and I make losses in a year, I can tell my equity shareholders that I will not give you anything today because I did not make anything today. So that is where you differentiate between somebody who lends money to the company who will get a fixed return, low risk, low return, whereas somebody who is invested in a company as an equity shareholder who is participating in the ups and downs of the company. That is why companies need to come to the market and raise money in the form of equity, where they don't have a commitment to service equities in the form of interest on payments, which is called as dividends in the form of equities. Neither do they have the pressure to repay the money, because when you buy an equity share, there is no maturity date for the equity share. The equity share is going to last forever, or rather it is going to last as long as the company lasts. Whereas in case of a loan, the company knows that there is a timer on the loan. They will have to repay the interest and as well as repay the loan once the timer is done. That is the reason why companies need to come to the market, right, and raise money in the form of equity. And that is why we have this entire elaborate trade cycle to facilitate this process for companies to raise money for expansion, and also to facilitate investors like me and you to participate in the growth of this company. And this is where we introduce the term IPO, which is known as initial public offer, which is when the first time a company comes to the market and tells the investors that I need your money to fund my expansion. So when the company, which till yesterday was only held by a few shareholders, decides to come to the stock market and say that I want to raise money in the form of equities so that you can participate in my growth, and I am having access to your money so that I can grow my business and you can participate in my growth in turn. That is when the company launches what is known as an initial public offer or an IPO, and that is the first time you as an investor get to buy a equity share of that particular company. As a process, what happens is the company which was private till now comes to the stock market, or what we know as the faces as NSE and BSE. They come and put a proposal to raise money for certain expansion they want to do, and all that information is disseminated to all the investors who would be interested in investing in the company, and then they give their offer to buy those shares of the company. And once those shares are allotted to them, the money goes to that particular company which has raised in the form of IPO, and they can then use the money for growing and expanding their operations. I think it's best if I take an example to run you through this. We are all familiar with the brand name Domino's, which is known for its pizza delivery services. The company that owns the franchisee for selling Domino's pizzas in India, Sri Lanka, Nepal and Bangladesh is Jubilant Foodworks. It is an Indian food services company. Jubilant Foodworks owns the master franchisee rights to set up and run Domino's stores in these 4 countries. Recently, the company also took up the franchisee of another popular brand in the West by the name Dunkin' Donuts. The company was started in 1996 when it set up its first store in India, but over a period of time, it has grown to the size that we know of today. It was not without a little help from investors like me and you. The company came out with an IPO in 2010, wherein they wanted to raise capital so that they could use that money to expand their operations and also prepay some of the loans that were outstanding at that point in time. Jubilant Foodworks came out with an IPO at a price range of 135 to 145. The reason a range was given is because it allows people to bid for buying the shares of the company depending on what they think the company is worth, between 135 and 145. Eventually, the company was able to raise the amount of money they wanted, and it listed on the stock exchange, meaning it traded for the first time on the stock exchange for a price of 161 in February 2010. So if we go back to our investor, that is Arjun, if he had bought 1,000 shares of this company at the IPO price of 145, and he would have paid this money to Jubilant Foodworks in January 2010. At that time, the IPO cycle was much longer. It took almost a month for a company to start trading on the stock exchange after they came out with an IPO. Today, the cycle has reduced drastically to less than 10 days. If Arjun would have bid for 1,000 shares in Jubilant Foodworks and bid at a price of 145 rupees per share, he would have transferred 1,000 into 145, that is 1,45,000 rupees to Jubilant Foodworks, who in turn would have assigned him 1,000 shares, which would have got credited to his Demat account. Now, since this is the first time the company is issuing shares, the company had issued a total of 1.1 crore shares, and now Arjun had bought 1,000 shares, so he owns that much small fraction of the total number of shares of the company. because he paid that much amount to the company against which he was assigned 1,000 shares. After he paid 145 rupees to the company in January, the company started trading on the stock exchange in the month of February. So on Feb 18th, the company traded for the first time and it traded at a price of 161 rupees. So you can see in a short span, Arjun actually made a quick small amount of profit on the shares he invested in this particular company. This is the second big reason why companies come out with an IPO. Apart from the fact that they want to raise money from investors, they want their shares to be traded on the stock exchange among a huge multitude of investors so that the real value of the share can be determined. So while the company thought that 145 was a fair price at which the company was raising money, eventually when they started trading on the stock exchange, they traded at a higher price on the very first day. So when lakhs of investors were buying and selling shares of Jubilant FoodWorks, those investors decided that, or those investors who are nothing but collectively known as the market, the stock market, decided that the value of the share should actually be 161 rupees and not 145, because of which they started trading at a much higher price. And so somebody like Arjun, who bought 1,000 shares, was actually sitting with a small profit of 16,000 in less than a month if he decided to go ahead and sell these shares. Now the question is, should he sell his shares when the company started listing at a higher price? Now the answer to this question is going to be very different from investor to investor, and that exactly is the beauty of the equity markets. At different price points, different investors or different fund managers or different experts, as they call, sitting across and giving their analysis, have different views about the same particular stock. So somebody may think that 145 is an expensive price for Jubilant FoodWorks. Somebody else may think that 145 is a very cheap price to buy the share. And eventually all this collective thought of many people coming together and trying to figure out what the value of the share is what reflects in the trading value of BSE and NSE. So when the stock listed, it listed at the price of 161. If Arjun had sold the share, he would have made a good profit of 16,000 rupees in less than a month. But what if he believed that this company was just starting off, it was having only a small number of franchisees, and it had a huge growth potential, given that we as an India are a huge consumer market? Had he held on to the shares, then what profit would he have made? If you look at the current price of the stock as of September 2020, the price of the stock is 2,347 rupees. So the value of his shares, which is 1,45,000, has gone up to 22,07,000 rupees, giving him a compounded annual return of 32% for his investments in Jubilant FoodWorks. So had he sold off these shares when the company got listed, he would have made a profit of 16,000. But holding on till now would have given him a much higher profit. So whether you hold on to a share or not is a function of what you think a particular share will do. Will it do well or will it not do well? And that is where all your analysis comes in. You need to analyze various factors which go into determining the value of a share. And it is not necessary that every company that comes out with an IPO will succeed. If I give you two contrasting examples of Demat and Reliance Power. Reliance Power came out with an IPO in the year 2008. It was if I'm right, the largest IPO at that time in the Indian market. It came out with an IPO price of 404, and the day the IPO got listed, it got listed at a price of 440. So it seemed at that point of time like a good company which had come out with a IPO raising money for the projects where the company wanted to invest the money was into power generation, because that was the time we were highly deficient in terms of the demand and supply of power in India. But if you look at the current price of the share, it trades at a meager 2 rupees 30 paisa. That means we have lost 99% of the value of the company. If you as an investor had put money in this IPO, you would be sitting with a loss of 99%, because today the value of the share is only 2 rupee 30 paisa. Versus a IPO of another successful company, Demat, which is owned by the company by name Avenue Supermarkets Limited. It launched an IPO in 2017 for a price of 295. The day the IPO price listed, it got listed at a price of 600. That is, the value almost doubled in a span of less than a month. The reason being, the market participants who were buying and selling the share thought that the share is worth much more than the 295 rupees, and that's why they assigned it a price of 600 rupees based on the trades that were done on that particular day. And if you look at the current price of the stock in August 2020, it trades at a value of 2299 rupees, which is almost a 10 times growth in the value of the stock from 2017 March when it came out with its IPO to August 2020. So this kind of gives you an idea of the amount of wealth creation that can happen in stocks, and also the amount of wealth destruction that can happen in stocks if you don't choose the right stock. Now, to be able to pick the right stock, you should be able to understand the risks associated with a particular stock. Let's discuss the risks associated with equities. If you go back and revisit our first chart where we talked about the returns for investing in equity markets, the chart is very similar to the chart we can see on the left hand side, where you will see a lot of ups and downs when you invest in a equity stock. Whereas when you put money in a fixed deposit, you expect to earn a fixed return over a period of time. Whether a company does well or not, you would want to get your 7%, 8% without any upside and with an expectation of nothing on the downside. But when you invest in an equity stock, you are willingly investing to participate in the upside as well as the downside of the company. So the variability in returns that you will get by investing in stocks, both in terms of the stock appreciation and in terms of the dividend that you will earn, is going to be very high, and you should be prepared for that before you decide to invest in a equity stock. Let me introduce some technical terms here for you so that you start getting a hang of the language you must be talking when you're talking about equity stocks. Because one objective of this session is, by the end of this session, we want you to start gossiping about stocks just like you gossip about, say, Hollywood or Bollywood. So two major risks associated with investing in equities is systematic risk and unsystematic risk. Though these words are pretty fancy, let me break them down for you to understand. Systematic risk is basically the risk which is associated with investing in the markets as such, or it is the risk which the entire market is exposed to. Whereas unsystematic risk is the risk which is associated with investing in a particular company or sector. If you take the example of how various companies have been affected because of the COVID pandemic in 2020, in the month of March, every company, irrespective of what sector they belong to, irrespective of how good the company was or how bad the company was, how well they performed in the past, every company was affected and everybody had lost close to about 30% of their value in the month of March, because they were exposed to a systematic risk which was in the form of a COVID pandemic hitting the market, right? So when we refer to systematic risk, we are largely talking about the geopolitical risk or the economic risk, which irrespective of how good or bad company you are, you will get affected by this risk. Unsystematic risk is the risk that affects only a particular company or an industry. To give you an example, if you look at the cigarette industry in India, it is constantly known for being targeted by the government because they do not want to encourage the consumption of cigarettes. They constantly keep increasing the taxes that apply to this particular sector. So each time the government increases the taxes, it has an impact on only that company or that industry which is being affected the most. So unsystematic risk is something which is localized to a company or an industry, whereas systematic risk is which is going to hit the entire market irrespective of who you are. Naturally, systematic risk is something which is external, whereas unsystematic is an internal risk. Another example of systematic risk is when the interest rates go up. If the interest rates go up, then it becomes expensive for a company to borrow, and that becomes expensive for any company, how good or how bad you are. When overall the trend is high interest rates, it's going to impact all the companies trying to go and borrow money from the market. Whereas something like a business risk, when a business is not being handled well, right? When it is not managed well, when it is not executed well, that is something which is specific to a particular company, and that is unsystematic risk. So a Reliance Power is today valued at 1% of its original price because of the unsystematic risk of the management not being able to execute those projects and deliver, and that was a business risk which they had. and that is why today the shareholders have lost money in that particular stock. So that is something which is specific to only that company, whereas there are many other power companies, be it Tata Power or others, who are still doing well today. How do you manage systematic risk is by ensuring you have proper asset allocation across the various asset classes, versus how do you manage unsystematic risk is through portfolio diversification. So by ensuring that you don't have all your eggs in a single company, you have not invested all your money in say Reliance Power, had you put the money across a larger set of companies, if one company goes bad, because of the business risk associated with that company, you are able to kind of diversify your portfolio and manage your unsystematic risk. Systematic risk is something which you will always be exposed to, because once you invest in the market, you will always have the risk of the market variability coming and hitting you. Just like if you take your car out, you can be an expert driver, you can take all the precautions in the form of a well-serviced car with airbags, etc. But you always have the risk that there can be a small chance of an accident happening. You can be well prepared for it, so that if it were to happen and hit you, you are able to tide through it. In the same way, when you are exposed to the various factors which cause systematic risk, whether it is a political factor or economic factor, asset allocation ensures that you are well prepared to take that loss and you are able to manage it well, because you are not over the board in any particular asset class. An example of the systematic risk is the 2008 market crash. Irrespective of which company you were, what segment you belong to, what sector you belong to, what industry you were in, all those companies were affected when in 2008 the markets crashed, and the result was a loss or a sea of red across all the companies you can think of in the equity sector. Whereas when we talk about the unsystematic risk associated with investing in equity, it is that risk which is specific to a particular company. So business risk is basically the company not being able to manage its business well, right? When you invest in a particular company, you are investing in the future profits of the company, and those future profits will get realized only when the company is able to execute on its vision and transform its plans into action, and that is what gets translated in the form of profits which you enjoy as a shareholder. Another example of unsystematic risk is a risk which is associated with high use of debt by the company. So if there are two companies in a single industry and one company decides to use a high amount of debt to able to fund its operations, then if the cost of debt goes up, or if for some reason, say like the pandemic hit and there were no sales, but the company was obliged to repay the people from whom it had taken a loan, then the company is hit by an unsystematic risk of having too much debt in its balance sheet, and that can have a huge negative impact on the overall performance of the company. That is why it becomes important to have a good understanding of the various risks associated with investing in equities and ensuring that you are well prepared to manage those risks as and when those events hit you, which can have an adverse impact on your portfolio. Now that you have a fair idea of the kind of returns that you can make by investing in equities and the varied kind of risks associated for investing in an equity share, let me make a small attempt to answer the most widely asked question of how do I select an equity stock? I think this is the most difficult question that can be asked to a financial advisor as to how should you select an equity stock. The reason being that the stock markets or your investments in an equity stock are exposed to a varied of factors, some which can be anticipated and many which cannot be anticipated. And these are factors which are being analyzed by thousands of analysts all across the world, and each of them coming up with their own interpretation of how these factors will affect a particular company, and all of them assigning a very different future value to the company based on what they expect the company should perform. And these expectations are being translated into trades by millions and crores of investors who are doing trades of buy and sell on a regular basis, because their expectations keep changing as the economic factors which you would expect to affect a company, one, the factors that affect a company change, and second, the intensity which these factors affect the company also keep changing on a daily basis, on a very dynamic basis, because of which the share price of the company changes every day. Every day, different analysts are coming out with different understanding of the company and trying to assign a value to the company, which is resulting in a lot of trades being done by investors who are following their respective advisors or analysts, and that is in turn showing up in the share price of the company. While it is a subject topic of a complete 15 or I would say 150 hours course to talk about how you should select an equity stock, let me give you the extreme basics in the form of the 3 most important factors that you must look at when you decide to buy a equity stock. What are these 3 factors? The first and the most important factor when buying an equity share is, do you understand the business of the company, right? Because what you're doing is you're betting that a particular company is going to do well, and that is when you're deciding to buy the stocks of the company. So you would want to invest in a company only when you understand the business of the company. If you look at a company like Coke, it is easy to understand the business of the company because they're selling products which are visibly available everywhere, and you keep a track of how well the company is performing based on how much of its product they're able to sell. Same thing goes for a company like Apple, wherein you can easily understand in terms of how many products got shipped, how many got sold, so what should be the profit of the company. If you pick up a company like a pharma company which has an extremely complicated business in terms of the R&D they are running, the kind of products that they have in the pipeline which you and I may or may not understand, the kind of markets they are selling the products to, their exposure to foreign markets apart from their exposure to Indian markets, the various products in pipeline, the different research stages they are in, the actual impact that particular product can have on curing a particular disease. When you don't understand a particular company well enough, you may want to think twice before putting your money there, because you put your money and for some reason an inspection happens of that company's facility in India and the prices go crashing and you're wondering exactly what went wrong. So the first and the most important factor you must look at when you're buying an equity share is you need to understand the business of the company, so that, broken in a simple term, you need to know how exactly the company is making money. If the company is making money selling Coke bottles, how much does it make when it sells a Coke bottle? If a company is making money selling iPhones, how much money does the company make when it sells an iPhone, right? So once you understand the business, you are able to relate the various factors associated with the company, various market movements that happen, and take a call on, is it something which is positive for the company or is it something which is negative for the company? So when Apple is able to sell more of its product in a new market like India, which it was never been able to sell for the past many years because of the high cost of the product for a country like India, you realize that when they set up a plant in India and are able to sell products at a comparatively lower price than in the past, and that is increasing their sales, that is where they're seeing an expansion in their market, and that should do well for their market price. But when you look at the overall contribution of a country like India in the overall sale of Apple, it is still very minuscule. But what is promising is the factor that they are growing at a pretty good rate in India compared to other countries. All said and done, understanding the business will help you take a decision on when various market factors move, when various systematic and unsystematic risks change with respect to a company. You understand exactly how much they are going to impact a particular company. The second most important factor is the ethics of the management and the executional capabilities of the management. This you can see by looking at the history of the management. If I were to give this in the form of examples, if you look at what happened to an HDFC Bank versus a Yes Bank, both were considered to be the darlings of the stock market about 3 to 4 years back. And for the last, I would say 8 to 10 years, both of these have been giving fantastic returns. But eventually, Yes Bank hit a wall and the share price of Yes Bank fell by 80-90%. Its management had to be changed. RBI realized that they were not providing for loans well enough. There were a lot of gaps in the management of the company. There were a lot of gaps in the balance sheet of the company. It resulting in where it is today, where it had to be bailed out by some of the other banks. Right? Both HDFC Bank and Yes Bank had a very promising future, had a very promising business setup, right? But where they differed largely was in their management. One, the ethics of the management, and second, the executional capabilities of the management. That is where Yes Bank lacked, and that is where they lost. Even the earlier example we discussed about of Reliance Power came out with an IPO asking money for setting up the largest power generation project in India. But if you go back and look at their history, the management did not have the executional capabilities. They did not have the background or a history of having delivered on projects of even half the size. When they didn't have the executional capabilities, betting on such a company actually going ahead and setting up and delivering profits on such products was going to be a tall task. Executional capability of the management combined with the ethical background and the ethical history of the management plays an extremely important role in helping you determine whether you should buy a particular stock or not. The third important factor when you're buying an equity share is what is the price that you are paying to buy that particular company. This is something which cannot be ignored, and this is something you should relate to your day-to-day purchases. Today, when you go and buy a product from your Kirana market, you want to be paying a fair price for it. You can decide to buy a soap which is worth 10 rupees or which is worth 100 rupees. But when you buy a soap which is worth 100 bucks, you know that you're getting that much value from it, or it has a certain chemical mix which is good for your body, and that's why you want to pick it up, versus buying a soap which is worth only 10 bucks. It is the same as whether you walk into a hotel which is a 3-star hotel, you pay a lower price. For a 5-star hotel, you pay a higher price. Similarly, when you buy companies which have been showing a good amount of profitability for a long period of time, which have a fantastic management, you would be willing to pay a higher price for such a company compared to some other company. But even when paying a higher price, you do not want to be paying an exorbitant price, right? For example, if you are in a city like Bombay, a 3-star hotel is going to cost you about 5,000 to 6,000 rupees for a night, whereas a 5-star hotel is going to cost you about 10 to 12,000 rupees for a night. If a 5-star hotel is available at a price of 40,000, 50,000, you may want to put a question mark on, is it worth paying so much for a night in such a hotel? In the same way, when you look at buying a particular equity share, it is important for you to pay attention to the price that you are paying for buying that small portion of the business, because if you overpay, you are never going to make returns from that particular company. With this background on the factors you must look at when you want to buy a particular equity share, let me take up some examples to simplify things for you. If you look at Indigo, which is owned by a company by name Interglobe Aviation, it is a company which is in the business of flying people from one place to another, and it is technically a low-cost carrier. Low-cost carrier meaning they do not have frills. They are in the business of flying people from point A to point B at the cheapest price possible. A question which many people actually ask is, why doesn't Indigo have a rewards or a loyalty program? If you remember, when Jet Airways was operational, its loyalty program was something which many people went for. And today, many of the full-fledged airlines, being a Vistara or Air India, all of them run loyalty programs. But Indigo, in spite of having the largest market share of aviation passengers in the country, it does not have a loyalty program. It may seem odd as to why Indigo does not have a loyalty program, but when you go and talk to their management, it's very clear for them that they are in the business of transporting people from point A to point B at the cheapest price possible. That is the business they are in. They're not in the business of running a loyalty program. What they feel is that with a good network size, that is giving their customers an option to fly across different times to different cities, right, and ensuring that they are punctual, they will get their customers. They don't need a loyalty program to get their customers. And if you go back and think, when you are flying, what is the most important factor you're looking at? The reason you're taking a flight versus going by road or rail is because you want to save on time. And to ensure that you save on time, you want to ensure that your flight takes off on time and lands on time. And your first choice of taking a flight would be based on its punctuality. And that is exactly what Indigo delivers to you. And that is why they have become the largest carriers in the country today. And even when the COVID pandemic hit, this was one of the rare companies which had enough cash reserves to be able to sustain COVID and the months of low operations. So instead of trying to copy the competition and trying to come out with a loyalty program, Indigo has done really well to stick to its core business of flying people from point A to point B at the cheapest price and flying always on time. And that is why they become the largest flight carriers in India. Let's look at a completely different industry in the form of soft drinks. If you look at the soft drink industry, Pepsi and Coca-Cola occupy or kind of enjoy close to 70 to 75% market share of this particular industry. Compared to the previous example we took, whereas the aviation industry is considered to be a highly intensive industry in terms of the competition from various players, because of which no flight operator is able to actually increase their prices beyond a certain amount, because there are a lot of competitors in the market, and if you try to push your prices up, nobody's going to buy your tickets because there are others at a lower price available. Versus you come to this industry of soft drinks, it has been largely a duopoly industry. Duopoly meaning there isn't much competition from Pepsi and Coke. If you look at if you walk into any kirana store, walk into any restaurant, you will find that the entire shelf space is occupied by Pepsi and Coke and their products. So Coke has a range of products, Pepsi has a range of products apart from the drinking waters that they sell, and they kind of rule the industry. Now there are multiple reasons why they have reached the place where they are after the years of investments in marketing, that they've been able to get their brand recall and being able to capture the shelf space in the kirana stores. Since Coke and Pepsi are part of an industry which is largely a duopoly, it works a lot to their benefit because they don't have to struggle for sales every day. Obviously Pepsi and Coke have to keep innovating themselves, come out with good products, sell the products to their consumers and keep them happy. But having said that, by being in a duopoly industry, they do not have that much competition, and that makes their life that much easier, and it makes these stocks that much more attractive for you to buy as an investor, because these guys are in a duopoly industry and they do not have that much competition from other players in this industry. From Coke, let's move to a completely different business of the NBFCs, which are known as the non-banking finance companies. NBFCs typically give you loans so that you can use the loan to either buy yourself a home, buy yourself a car, use it to grow your business, or even to purchase the next mobile. Let's focus on that segment of NBFCs which lend you money just to buy your home. Let's just look at that segment. The reason I'm saying is, if you were to think as an investor, if you look at 4 NBFCs, all 4 of them in the business of giving loans to allow their customers to buy their dream homes, what do you think can be so differentiating of one business to another so that you would want to prefer a particular company? If I just take the example of Canfin Homes Limited, which is an NBFC which gives you loans for your home purchase, they have given a return of almost 29 times of your money in the last 10 years. The reason they've been able to do so well is, yes, they are in the business like any other home finance company of giving loans for you to buy your house, but they have focused by giving smaller loan ticket size. So compared to an HDFC, the average ticket size of a Canfin home is much smaller. Second, they focus largely on salaried employees to give their loan. So when they are scouting for customers, they prefer a target audience of salaried people, because they know that salaried people love their homes and will not default on their homes at the risk of losing their homes, and as a result of which the NPA of something like Canfin Home Loans is much smaller than its industry. And that is because of the culture they have developed in terms of, one, giving small ticket size loans, and second, focusing on the salaried individuals so that the overall losses they would expect in terms of defaults are minimized, and they have a very good repayment culture among all their customers, resulting in higher profits for the company, and that in turn resulting in higher returns for you as their investor. The reason for taking up these examples were to give you an idea of how you can start thinking on lines of what equity shares you want to buy. Start analyzing the business, start looking at why a company is making profits, why a company is not making profits, and once you understand this, you will be able to start applying your mind to, is the company worth buying or not? As I said, first thing you need to do is understand the business of the company, so you know exactly how the company works and how is it making its profits. Look at the background of the management of the company to understand that they have the executional capabilities and they are of a good ethical background, so that they are not going to make short of your money, and they're going to deliver the returns that you invested in their company for. And the third factor when considering equities, look at the price that you're paying for buying a particular equity. If you land up overpaying for a company, it may be a fantastic company, but if you overpay for it, it's going to be a long period of time before you actually see any kind of returns for your investment in a good company for which you overpaid. Another factor which you need to look at when investing in equity stocks is the size of the company. We've discussed about the fact that equities are the highest risk, high return asset class, but within equities also, the size of the company determines how much risk you're taking. Basically, the size of the companies is divided between large cap companies, mid cap companies, and small cap companies. Let's look at each of them. Large cap companies basically refer to the top 100 companies by their capitalization. So if the entire market were to be put in the order of the companies in terms of the size of the companies, the top 100 largest companies qualify as large cap companies. The next 150 companies, that is company 101 to 250 by its market capitalization, these are the companies which qualify as mid cap companies, and all companies after the 250th company or from 251st company onwards, they are called as small cap companies. To give you an idea, Reliance Industries Limited is a large cap company and it had a market cap of 14.53 lakh crores. Versus if you move on to Bata, which is a mid cap company by size, it had a market capitalization of 18,100 crores. You can already see the difference between the size of the large cap company versus the mid cap company. Versus you move on to PVR Cinemas, which is a small cap, it has a market cap of 2,659 crores. These are all numbers based on the traded values on September 21st, 2020. The market capitalization of a company, which is nothing but the total number of shares multiplied by the share price of the company on any particular day, changes on a daily basis because the share prices change every day. But this gives you an idea of what a large cap, mid cap and a small company would look like. Now, why it is important for you to understand this is the risk and return of a large cap company is lower than the risk and return associated with a small cap company. Let me explain this with an example. If you look at State Bank of India, which categorizes as a large cap company, it has close to 24,000 branches in India today. Versus if you look at AU Small Finance Bank, which is considered a small cap company because of its size, has only 400 branches in the country. Now, if you were to put your money in a company like SBI, State Bank of India, do you think the company can double its profits in a year? And if doubling profits requires it to double the number of branches or even increase the number of branches by 50%, do you think it's possible? The company is so huge that it cannot double in size. It is already way too large. It is going to grow at a steady rate, but doubling in size, it's a big question mark. Versus an AU Small Finance, which has only 400 branches, if it wanted to double in size, can it double its branches to 800? Yes, it has been done in the past and can easily double its number of branches in a year or maybe in 15 months to 18 months. So if AU Finance is able to double its number of branches, double its lenders and borrowers, double the amount of money they're able to give out, they can actually double their profits and expect their share price also to double. But at the same time, do you think an SBI can shut down overnight? If there is any risk in the market or if a systematic or unsystematic risk hits the company, do you think SBI can shut down overnight? No, SBI is way too large a company. It has enough size in its balance sheet to weather all the kind of risk and it will not shut down overnight. Versus the AU Small Finance Bank, which is still a very small bank, the chances that it can shut down if an event were to hit it and it does not have adequate capital to face the market risk that it is exposed to, the chances are much higher there. It can be a well-run bank, but if you were to do a comparison between the two, AU Small Finance is a small cap company and is associated with high risk, high returns, whereas SBI comparatively is a much larger company, and compared to AU Small Finance, you would expect lower risk and lower returns when you invest in SBI. So when you invest across various stocks, an understanding of these parameters helps you gauge the amount of risk that you're taking when you invest in a particular company. I hope by now I have not made you scared of this asset class called equities. What we try to do is try to simplify the basics of equities as an asset class for you. and so that you can start taking your first steps to reading about equities as an asset class, to understanding how various events affect various companies, and start taking the first tiny steps towards putting your first money in equity as an asset class. We've discussed that there are a number of factors, both external market related factors and internal company related factors, which have a huge impact on the final returns of a company. The most important thing you should keep in mind when investing in stocks is common sense. If you apply the basic common sense principles when investing in a particular stock in terms of the kind of returns you expect from investing in the stock, that will help you a lot. What I mean by that is, when you wake up in the morning and the first product that you use every day is a toothpaste by name Colgate, you may want to think about how much money does Colgate make and is it a good investment or not. When every seventh home that you walk into says that they have used Asian paints to paint the house and make them look beautiful, you want to look at how good or bad that is as an investment opportunity. Each time you walked into a Kirana store and you found that it is Demat which is always crowded because they offer the maximum variety of goods at an extremely competitive price compared to others, then you want to look at, is Demat a good investment price or no? If Bata is always the go-to option for buying shoes for a consumer in India because they sell shoes at a price which is apt for the Indian audience, given that Indians are very price sensitive, then is that a good stock to buy? If every week you find yourself consuming Maggi once a week, although you're predominantly a person who always eats home food, but that craving for Maggi is always going to be there, then is that a good company to look at? Is Nestle India the next investment you should be making? And if you love the quality of products which Gillette is able to offer, whether it is for the males or the women, and you simply cannot think of any other company which offers a razor which is as good in quality as Gillette, then you may want to evaluate whether Gillette India is the investment you want to make. Once you start thinking on these lines, you will automatically start gossiping about stocks. Your daily conversations over the lunch or evening chai are going to be about which stocks are doing well and which are not doing well, and more importantly, why they are doing well and why they are not doing well. Once you start doing that, once your daily conversations become about stocks, that will make you more apt as a equity investor. The most common question that we get asked is, where do we start? And what we tell is, where you need to start is you need to start reading. Start reading about companies, start reading about economies, start reading about countries, start reading about various factors which are affecting all of them. Pick up the newspaper every day, not just the regular newspaper, but a business newspaper, so that you get ideas of, you start reading about various factors affecting the businesses and companies and why they're affecting them and how they're affecting them. To give you an idea, Warren Buffett, who's considered the greatest investor in the world, he reads on an average 500 pages every day. If you just think of it, 500 pages every day, that to somebody who's considered the greatest investor in the world, if he has to read 500 pages every day just to keep up with the changes in the market, you can imagine where me and you need to spend our times, right? We have to be reading quite a lot, because it is when we read that we are able to gain a lot of knowledge and apply that knowledge when we analyze the companies. Apart from the daily papers, you should pick up as many as books you can, because they are a storehouse of knowledge. Generally, if you are a fresher investor, it is a good idea to start reading, say, Beating the Street by Peter Lynch or One Up on the Wall Street by Peter Lynch, because these are more at a basic level and will give you a good understanding of how he did well as a fund manager, why he did well, what companies did well, and why they did well. Once you get comfortable with these books, you can think of picking up The Intelligent Investor by Benjamin Graham, which is considered to be the Bible for equity investors. To sum up this extremely long equity session for you, the way you make money by investing in equities is through appreciation in the price of the stock, as well as the dividend income that you earn on a yearly basis. And instead of running away from the risk associated with equities, the best way is to learn how to manage the risk associated with investing in equities and make the most of your equity investment returns. The source of wealth for people have changed over generations and over hundreds of years, and today equity as an asset class is the greatest source of wealth creator for you. With this, I would like to bring a close to our session on equity, and our next session will be on understanding of gold as an asset class.